Right, good morning, ladies and gentlemen, and thank you again for joining Boutiques on Wednesdays on the session on multi-asset funds and what do we look for in this world of uncertainty. A lot of heat out there in the market and a lot of questions on asset allocation, regional exposure, and some might even want to know, is this the time to duck and cover? And if I do so, will my clients not lose out? We're trying to figure out what the playbook is for this environment, and nobody seems to know. Do I sit and wait, or do I need to reposition? And then when you look at multi-asset portfolios, there are multiple ways to construct these portfolios. Some of you may follow a building block approach where you pull all the levers on asset allocation and regional allocation and even sometimes cap sizes. But some of you may follow a multi-asset fund approach. And what I mean with that, by way of example, it's combining a number of, let's call it, for example, balance funds into a client's portfolio, where you then focus on managers that are highly skilled in asset allocation and with low correlations. There's no right or wrong way of constructing portfolios for clients, but it rather speaks to how involved you want to be on the asset allocation calls. And of course, then there are the practicalities of implementing these calls on client level. And it's maybe because of the latter that we see renewed interest in multi-asset funds, because you may have the skills to pull all these levers on asset allocation, but like I mentioned, implementing these views can sometimes be challenging. Joining us this morning for this discussion and to look at the world of asset allocation and multi-asset funds and how they see the world is a very experienced team with decades of experience, if you look at them collectively, in successfully managing multi-asset mandates. And by way of introduction, we've got Jacobus de Kok from Fairtree, Mark Seymour from North Star Asset Management, Rian Wagner from Investec Wealth Management, and Sihle Siswana from Sasfin Asset Management. Good morning, gentlemen. Thank you all for joining us this morning for this really exciting discussion. I love multi-asset funds because you get to cover just about everything. Right. If I can maybe start, Rian, with you, because your business is a little bit different, or how you manage multi-asset funds to the rest of the panelists. And looking at Investec Wealth Management, you specifically focus on multi-managed funds, and we will specifically look at the Investec BCI balanced fund of funds. Maybe by way of introduction from your side, can you maybe explain to us how your business works, why multi-managed fund of funds, and how that fits into the Investec Wealth Management business?
Great, thanks, Eugene. Maybe the best way to introduce our business is to clarify who we're not. Investec Investment Management is not 91. Our Investec Wealth and Investment business has had its investment capability since our very inception. And the investment team is held within this part of the group and is now known as Investec Investment Management. But I think it's important to highlight that the team and the investment process is not new. We're a well-established international specialist investment manager with assets under management of around 280 billion rand. And I think the audience will appreciate that our philosophy is deeply rooted in finding solutions for wealth managers and financial advisors across a range of about 25 underlying funds. Our single manager business is one part, and the other part is the multi-manager business, which is where I fit in. And that was formed about 21 years ago, really for clients looking for an investment manager that can manage their global exposure across global markets. And it's the manager research capabilities that, as I mentioned, has been 20 years in the making. We celebrated our 20-year track record on one of our Investec World Access funds, and it's the same philosophy and process that we employ within our domestic range of multi-manager solutions, specifically designed for those investors looking for an additional layer of multi-manager or manager diversification. And of course, our well-proven tactical asset allocation capability in these multi-asset funds. And so the fund you mentioned today, our BCI, Investec BCI Balanced Fund of Funds, has a 13-year track record with assets under management just under 10 billion Rand, a consistent top quartile performer, and was recently recognized by Morningstar as the best fund in the moderate allocation category within South Africa. So we do the manager selection ourselves, we do the tactical asset allocation ourselves, and so it's a combination of bottom-up and top-down portfolio construction.
Yeah, and thank you for that. And we're definitely going to unpack a couple of those views on your asset allocation, how you think about manager selection. We'll get to that in a bit. Chris, if I can maybe step over to you and looking at things like tactical asset allocation, when we engage with pure equity managers, whether it's global or local, you know, they almost seem a bit more oblivious to the macro environment because they need to speak to their book. They buy equities, but in a multi-asset mandate, you can buy anything. When you look at asset allocation, any given point of time, whether it's a multi-asset low or medium or high equity mandate, let's talk about the Select BCI Balanced Fund. How sensitive are you to the macro environment when looking at asset allocation, or is it purely a bottoms-up approach?
Right, thanks, Eugene. I think it's first of all, just to recap our process on the equity side, we are very focused on the top down as well as on the bottom up in selecting the correct sectors or selecting the correct securities within the portfolio. And we have specialist teams that performs that within the balance fund. So we have the SA equity team that selects stocks on the SA equity side, and a global team that selects stocks for the global side. So you get that specialist approach in the portfolio. I'm responsible for asset allocation, and so my job is to look at the world, look at the key macro drivers, see how that would potentially influence the asset allocation and the sector selection and the security selection. Now the nice thing about my role is I'm also the macro strategist in the business. So my top-down input goes straight into the security selection of the underlying portfolio managers. So there's a nice way of combining these two views in the setup of the portfolio. So it's extremely important what happens in the US as the global policy center of the world, what happens in China as the global growth driver of the world. And then we're seeing big changes happening in Europe at the moment. And then do not forget that South Africa, it's also been impacted by these global dynamics and our local dynamics as well. Another stat that I want to end up with is that, as we all know, a large portion of SA's equity returns and revenues actually comes from overseas. And so what happens in Europe and in China and in the US is extremely important.
Thank you for that. And Sihle, if we can maybe stick to the theme of thinking and how you approach portfolio construction from a asset allocation point of view. I know that Sasfin is a value buyer's house, although you don't box yourself into that camp of being a value manager. But just explain to us a little bit, again, if you do asset allocation with a value buyer's approach, is it more bottoms up, or what informs your current asset allocation views?
Thanks for that, Eugene. So firstly, I mean, the macro has become more important now, and you just cannot ignore it. So we've got a blend of managers that have seen many cycles here. As a result, they feed into our macro thinking. So while we do blend the two, your bottom up and your macro, I mean, the starting point really is at the macro level and expected returns. We've got quite senior members in the team. You probably would have heard of Craig Pfeiffer, who feeds into the process. You've got your Errol, who's been around many years, Arno Lawrence as well. We've got just a wide range of team that feed into that. And then once you've sort of got those expectations around the asset classes, that's when the bottom up comes into play, right? You've got to be selective about the opportunities you choose within those asset classes. And like you said, I mean, you rightly mentioned, we don't box ourselves to one particular strategy. What you get in the funds is an element of growth as well, an element of quality. But yes, as you rightly mentioned, we do have a value bias.
Thanks, Sinclair. Mark, if we can maybe look at the North Star BCI managed fund, and again, just looking at your process, you work on, and we've seen a couple of your presentations on the roadshows. You work on an optimization model. Maybe just unpack that again very briefly for our audience. What does that imply?
Yeah, thanks, Eugene. So basically the way it works at North Star, I mean, we've been going now for 13 years, so boutique manager, 7 billion under management, so working hard to establish ourselves. The key members in the team have been around in the market for more than 20 years. So how we do it is we've got a buy list for each asset class. So, our business, we primarily fundamental based. So we, predominantly our work is bottom up. And we distill all the workings of all the analysts onto buy lists, which is then expressed as an expected return. And then what we do is we have a monthly optimization exercise where we integrate those buy lists into a blend of exposures that are applicable for each of our multi-asset funds. The business is quite simple. We've got a risk profiled range of funds on the local side and a risk profiled range of funds on the offshore side. And so, it's an exercise of making sure that those buy lists and the expected returns are as accurate as we can express them. And they also express, where we see value and where we see quality globally. When you carry out that exercise, you end up with active tilts in different asset classes that are applicable for the times. We're moving through some really interesting times at the moment. And Sinclair mentions from a macro perspective, there's some interesting challenges.
I'm gonna stick to this conversation. And in our initial interview, you actually mentioned something very interesting that I think is greatly missed by a lot of people, and I've seen it with DFMs as well. I've seen it how IFAs and clients sometimes screen multi-asset funds and they look at the global and the local exposure and they almost make a decision based on that. So if I can use an example, I mean, if fund manager A has 20% global exposure and fund manager B has 45, it doesn't necessarily mean that either one is wrong or right. But it speaks to, I think, more what they expect from a particular asset class. And I think that speaks to what you refer to as your buy list. But how does that buy list come together? Do you have specific values that you allocate to, let's say, for argument's sake, SA equity, what returns you think you can get from that relative to global equity, and how does that support or inform your asset allocation decision?
Okay, so I mean, very briefly, each analyst covers between 20 and 25 stocks. And then, if you distill that across our business, you kind of very quickly appreciate that in terms of bandwidth, we're covering 100 global stocks and roughly 80 local stocks. So the first port of call is to try and make sure that we focused on areas of the market that where we feel that we have an edge. And then it's up to the analysts to ensure that their take on those businesses and their valuations are as accurate as possible and up to date as possible. And then each of those numbers is then put onto a buy list. The buy list itself is optimized into a model portfolio, so that and then for each buy list you've got an expected return and associated assumed kind of risk metrics, and then it becomes a very simple exercise of, let's say, for the local managed fund, we want to target a risk that's in line with the peers. and one metric that you can look at there is the standard deviation. So, based on the history of data that we look at, currently that standard deviation through that period is currently 10.5% standard deviation. And then it's a simple exercise of saying, well, what is the best blend of our buy lists that will give us the highest return? And so, yeah, that's an exercise that we do. And, currently when we do that exercise, it's quite interesting because it's trying to force us into an overweight into local equities. And yeah, I mean, that's another discussion. I'm sure we could unpack that for a good half an hour, but that is one interesting aspect which is coming out of that exercise.
We're definitely gonna come back to that. You make it sound so simple, but there's obviously a lot more to it and a lot of work going into that modeling as well. But like I said, we'll get back to that. Rian, if I can maybe proceed with you. If we look at the world at the moment, we hear comments out there that some managers are at a neutral position on their growth assets, some are underweight, some moved from underweight back to neutral. But maybe just from an investor perspective, if you look at your balance mandate at the moment, and looking at your tactical asset allocation, where are you? Are we in a risk on or risk off environment? Are you underweight, neutral, on SA equity, global bonds perhaps? Where do you sit now?
So, Eugene, as part of, I guess, a global investment business, and Jacobus alluded to it, I think it's important that you incorporate your global view. And so, our whole asset allocation process is really governed by our global investment strategy group, which is a sort of a joint committee of our most strategic thinkers and senior investment professionals across the UK, Europe, and South Africa. And so, from a global perspective, that ranges from -3, which is most negative, to +3, which is the most positive. And at the moment, we're sitting at about -1, despite the recent sell-off in US equities. And then similarly on the local side, it follows a similar process. And in fact, there we are actually +1, so positive on South African assets. So, from a tactical perspective, which obviously feeds on from our strategic asset allocation decisions, which we can also discuss if you want, we would say we are overweight South African equities, overweight South African bonds, and underweight US equities specifically, and by effect, underweight global equities, just given the fact that the US forms such a large part of, the global market. I think it's important to realize, though, that this year is particularly going to be uncertain and unpredictable. And so I think it's important that we position our portfolios, in a very diversified manner, because we truly believe that you can't position your portfolio for a single outcome, just given the unpredictability and the uncertainty that's out there currently.
Maybe on that, and you did mention that you're underweight US equity, but I want to continue with that because we heard that frequently over the past week and a half, buy back in the dip. Are you buying back in the dip, sitting tight?
No, we are refraining from buying back. We've got concerns longer term in terms of earnings, in terms of the state of the US economy. And so we think there's probably a technical bounce, but we don't think that this is going to be sustainable. And so rather than playing at the margin, we're more comfortable just riding out this bounce that we're currently seeing.
Interesting indeed. Sihle, just specifically on your asset allocation, if I look at your onshore versus offshore, you've got about 36% in SA equity relative to about 30 global. We're going to unpack that global a little bit more just now. But looking at your SA equity exposure, I mean, where do you see the opportunities? Is it more in the mid-cap or SA Inc. space, or where is that?
Yeah, thanks for that. Maybe just to give you a rundown of our allocation. I swear Rian will probably took my script in terms of allocation. But yeah, we also overweight SA equity, 3% sort of neutral on our bonds, domestic bonds. We're underweight offshore, particularly on the equity side. So just going to our SA equity allocation, so our SA allocation. So I think the important thing to realize is that, there's new information now that is making us more positive. That wasn't there in the recent past, right? I think we all know that, we, around the government of the coalition that's in place, our view is that there will be a centralist approach taken. There will be a pragmatic approach around the budget, which is probably one of the key things to look out for within this coalition, within this current government. And so that's made us a bit more optimistic about the future. I mean, and a clear example is around the VAT, right? The discussions there clearly pointed to a pragmatic approach being taken. And also, if you look at what's happening around Transnet, we're seeing some positives. I mean, the key thing has always been, are we seeing tangible results of this reform agenda? And for the first time in a while, we're starting to see some positivity. So that's made us more positive. And we're sort of looking at the ignored part right now. So your mid caps have been ignored for quite some time. So we're sort of nitpicking there and increasing our allocation in that part. I don't know if I can maybe touch on other asset classes, but yeah, essentially we're bullish on SA at this point. I think despite the negatives, the positives that have come to the fore, it's recent information that I don't think has been built into asset classes and into the SA asset class.
Doesn't always feel very nice if you overweight SA equity, because if you look at things on the ground, it feels a bit different. But Chris, if I can maybe look at your views on the SA equity, you're also more bullish on SA?
Yeah, I think if you think about it from a relative perspective, we also see the world very uncertain. We think it's time that we're starting to shore up our defenses. We are at the end of the cycle. So while we are defensive in the developed market in particular, and also the US, and have been so for a while, we are also seeing opportunities in other places, and in particularly in South Africa, where valuations are still, I wouldn't say they're not elevated. Some of them are at fair value or still slightly cheap. But we see opportunities if you believe that there's going to be growth in the country, and we do see that we can still operate at around 1.5% to 2.5% growth, which is I think is decent. It's not where we need to be, but we can see some unlock and earnings growth in that environment that will help our retailers, our banks, some of the industrials, and some of these stocks are back at prices where they've been before the GNU at the same time last year. So we think that there's a lot of bad news that has now been priced in to some of these stocks that could provide you some upside if that does play out. We also see that in this uncertain environment, it could potentially be very much US focused, and that you could see some protection from the likes of South Africa and other emerging markets in this relative play. Unless something breaks, and we're not there yet where we see something breaks globally. So we are comfortable with that positioning of being on the defense in DM, but being on the offense and see opportunities in emerging markets and within South Africa.
Eugene, can I just add something?
Yes, please do.
Yeah, I don't think people really understand what has happened over the last year. I mean, South African equities and rands have given you mid 20% returns. Yeah. Our bonds close to 20%, and the S&P has only given you 6 or 7% in rands. So I think it's misunderstood, and what Jacobus is saying is so true. But it's so important for people to actually realize that despite the grim news out there on the local front, geez, our markets have done well.
It's done exceptionally well, and maybe to cotton on to what you said, Rian, and Jacobus here specifically, because I mean we've got high DTG levels, we've got a fragile GNU. Things are not as rosy as what they were end last year, especially not after the elections. We're getting ostracized by the US. Lots of talks on that. Probably going to drop out of AGOA. Who knows? But where's the growth going to come from if SARP pause on cutting rates? Do we need a catalyst for more value to unlock?
Sure. So I think if you think about, we became constructive on growth last year because we're seeing better, improved network economy growth, electricity and around Transnet. We saw the GNU on the policy side, and we saw the consumer environment changing. And I think that is the one leg that still remains, that the consumer is sitting with much lower inflation than they've seen in the last few years. The fuel price in rand terms is actually supposed to come down, over the next couple of months. We're seeing still that wages are rising above inflation, whether it's private sector or public sector. So from a consumer wallet perspective, there's actually the ability to consume. You see that in the retail sales. Real retail sales is up 7% year over year, 7% in real terms. And you see passenger vehicle sales doing extremely well. Now, the question is, when will this activity start to be converted into earnings growth? So this downside that we saw in the equity market over the last couple of months on the SA Inc. side has been driven by a derating. We're still waiting for the earnings growth to come through. And I know there's a big conference happening in Sun City at the moment, where we'll speak to a lot of these local companies and find out how they see the world. But we think if we fast forward 6 months out, 12 months out, we'll start to see some of this earnings come through. The consumer is still there. The second leg is investment. Now, there has been some dent to investment, but other countries outside of the US, like in Europe, they still invest in South Africa. We still see last year some big bond flows from foreigners into the country. There's still a need for grid build out, transmission build out, for the transport economy to be built out. And there's private sector incentives now building to become part of this project. The public sector is inviting the private sector to be part of it. It's happening at a slow pace, but it is happening. And if you look at the Nedbank project listing, you can see that there's a decent pipeline that's been pulled out. So I do believe we will see the investment come through. Maybe not at the speed at which we wanted, but at least I think we're still looking at a 2% plus growth over the next couple of years, if we can get there.
That would be very lovely indeed. Riaan, maybe just quickly a comment from the audience. And I think we all experience that again, looking at SA Equity. SA Equity underperformed for just about a decade. The last year has been exceptionally good. But one have to wonder, and Jacobus, I hear what you're saying. But do you think over the next, 5 to 10 years that SA Equity can again contribute significantly to client portfolios?
So, Eugene, I think, often we have short-term memories. If I go back to 2000, that was 2000 to 2010. That was the lost decade for US equities. And look what sort of the rest of the world did. Look at what South Africa did. And yes, it's true that the last 10 years have been a difficult place for South African equities. But, any prospect of future return is the price you pay today for an asset. And so we would argue that you're paying very expensive multiples for US equities, and you're getting cheap valuations from South Africa. So, I won't be surprised if the next couple of years turn out to be somewhat what we saw in the early 2000s, where, a lot of those US stocks went down, and they went down a lot, dragged down the overall market. And the rest of the world actually did okay. So, we're quite optimistic. As Jacobus mentioned, inflation is really low in South Africa. Even in cash, you're getting decent real returns, adding on a little bit of duration from your fixed income assets, plus, early double-digit returns from SA equities over the next 5 years. We think that this is a great and a fertile environment, to be invested and earn real returns for investors.
I tend to agree with that. I mean, we also know that, over the past 6 or 7 years, we scored a lot of our own tries. I'm not going to go into that. But definitely outlook is better. And I think, Jacobus, you painted a good picture on that. Mark, question from the audience. And you spoke to that, the numbers on the buy list. You actually need a real number to try to determine if an asset class or to what extent that's going to contribute to a multi-asset funds. Do you have specific numbers on things like, for argument's sake, SA equity, global equity, SA bonds for the next 12 to 18 months?
Yeah, so I mean,
being recorded, somebody on the spot here.
Yeah, I think I just want to revert back to the previous discussion. I think it's you know, as Rian said, you know, if you rewind back to 2014, you know, the local market was actually expensive and priced for decent growth. And what we had was you know, the complete opposite in terms of, you know, the growth falling off a cliff. And so it you know, it just talks to the point. You know, the returns you get is the price you pay. And obviously, you know, your growth environment, your growth engine is, or part of it in terms of GDP growth is very important. So I think at this point in time, you've got pretty decent valuations, and all you need is just some stability in terms of growth. And it's going to, you know, will form a very good foundation for decent returns. And, you know, the potential, well, yeah, I'll just leave it at that. Yeah, so you want to put me on the spot for exact numbers. I'm certainly not going to give you our exact numbers, but I mean, you know, in rand terms, so this is the other thing is, you know, you do this optimization exercise, you know, you have to, you know, for local multi-asset funds, you've got to translate everything back into rand expected returns. And so there, you know, your view on the currency has to come into play, et cetera, et cetera. Our local equity buy list is giving us potential returns of mid to even slightly higher than mid-teen returns, whereas our global buy list is giving us low double-digit returns in rand terms. So, I mean, both are actually very attractive still in terms of our own buy list. So I think what that translates into is, you know, even though we're favoring local equities, I think it's, I think what is good is, you know, at least for the sector, for a balanced fund, what's comforting, I think, is for investors to be able to realize a 5% real return is definitely a lot more in play versus than what was the case in 2014. So, yeah, I don't know if that answers your question. Yeah, mid to high.
It does, most definitely. And maybe Rian, on that, the comments that Mark made now, I mean, they hold a exposure on security level. They do the work. They can actually make an estimate as to what kind of returns they can expect. I mean, through all the work they've done, Mark explained it now. But in your funds, you don't hold the actual securities. You buy other funds. So how do you, in a multi-asset portfolio, how do you then think about fund manager selection when you can't actually hold the security and get a sense of what you think the returns are? Do you lean to particular investment styles, or how does that selection process work?
So I guess from the top down, you know, when we have I guess a positive view on South Africa, for example, as we do currently, we will populate that with, you know, 4 or 5 underlying managers in South Africa. And I think the most important point here is that, you know, we follow an active approach to investment management. I guess the South African market is a little bit smaller in terms of number of shares. So it's sometimes harder to distinguish between styles like you would globally. I mean, there's a myriad of different styles overseas. But, you know, in South Africa, I think you have guys that are a bit more benchmark cognizant, guys that are benchmark agnostic, and so a more pragmatic approach. And so, you know, we place a great deal of emphasis on the qualitative aspects of investment due diligence, which is supported by quants, not the other way around. And so, you know, we rigorously evaluate our managers, their investment process, and we try and identify managers whose performance track records, in our opinion, are repeatable. And so, you know, by getting to know these guys for a long period of time, we try and anticipate in what market environment they will do well and what environment they won't do well. And we try and blend them together. Okay. And so we're quite active in terms of changing up the shape of the portfolio by taking away from a manager that's maybe done particularly well last year and allocating it to someone that's done poorly, and also by looking at the underlying sector exposure. So we're not going to dictate to them where they must invest. But certainly, you know, we are quite active in terms of how we shape the portfolio.
But I mean, to do that, you have to have a very good sense of what the underlying managers are doing. So kicking all the tires and understanding where they're coming from and where they're going. Secondly, maybe just quickly more fund specific. I want to step away from SA equity. Looking at your global equity exposure, you actually buy the MSCI World. But you also mentioned you've got a value biased approach. But if you're buying the MSCI World, although you slightly underweight, does this not mean that you're buying more expensive US equity? I mean, everybody made comments on the US being expensive.
Yeah. So, I mean, maybe take a step back. So, I mean, a part of our core belief is that, you know, developed markets will continue to grow. If you look at the MSCI World, high exposure to the US, I mean, the US is pretty strong economy, so a strong driver for just GDP growth overall. And if you just look at that makeup, I mean, you've got an economy that continues to innovate. You know, you've got a myriad of industries. And so for us, it's not really to try to time it. You know, it's try to be exposed to this global growth, this growth engine. So would maybe so what we would typically do is say, look, you know, where's our neutral point? Currently, right now, as we sit, we're underweight based relative to our own neutral point. So we're underweight based on our strategic limits. However, we don't want to be too underexposed to this economy. It has continued to surprise. And if you just look at the opportunities I said that you have there, you know, if you try to time it, you can completely get it wrong, right? And so we're not saying that we are specialists in that, you know, we were great at timing, but we don't want to be too underexposed to an economy that continues to grow. So that's how we look at it. At certain times, depending on the theme that we see playing out, I mean, we have gone on to get specific bets, you know, individual stocks. But currently, just looking at valuations, whether you're playing at a thematic basis, maybe, for example, you're getting some tech ETF, we sort of look, it's expensive. So rather to de-risk the portfolio from that is maybe just go to a more diversified ETF and just sort of be underweight versus your own strategic benchmark.
Thanks. Chris, if I can maybe stay on global equity. I mean, two questions here for you combined. Has US exceptionalism peaked? And in your global carve-out, I mean, are you diversifying away from the US? And if you are, what are you looking at?
Yeah, I love that question because, you know, I think it's been a theme for us to say, look, that the US exceptionalism has potentially peaked. You know, and there's a few catalysts there, and I think the one most recent prevalent one is the DeepSeek R1 scenario, when China came out and said and showed that they could potentially do large language models at an AI at a cheaper cost. You know, what degree is still debatable, but at a cheaper cost, where you had huge expectations building to the US and a lot of capex taking place. That now has to be, I guess, revisited and realized that potentially China is competing not only now in AI, but if you look at, you know, solar panels, if you look at batteries, if you look at computers around the world, these things come from China. And so I think that, together with the fact that we've seen the Trump administration come in, that has induced a lot of policy uncertainty into the world, but it's also led to other countries starting to do more. You know, Europe has come out with this massive fiscal package over the next 10 years. And this is a generational shift for the likes of Germany and Europe. Their debt to GDP ratio is 62%, whereas their peers are sitting at 100 plus. They have huge scope to use fiscal spending to drive their economy. So you have that the US is slowing. The US as valuations are elevated, and that's potentially leading to the peak from a US perspective, but also the rest of the world has picked up the baton and realized that we need to do more to stoke growth, and that's also happening in China. So from that perspective, you know, we do think that, and we have been doing so, you know, for the last 12 months, we are underweight the US and we are overweight other parts of the world. In particular, we've been underweight US tech and overweight Chinese tech. Yeah. And that has been an early call that we've made, and we've been wrong, you know, for a large part of last year. But towards the end of last year and the beginning of this year, we saw that Chinese tech, which has often traded at multiples half of that of the US, has started to really done well. And one of the catalysts there again has been that meeting between the tech heads in China and Xi Jinping, where Jack Ma shook Xi Jinping's hand after he has been in corporate exile for a while. I think that shows that the Chinese often, it's a command-driven economy. They have been the ones that has started the 3 red lines back in 2023 that caused the property sector to go into a massive downturn. And they're now saying we need to stabilize the property sector, and they've been causing this tech sector a downturn because of the way that they perceive that sector, and now they're showing that they want to support them. So we need to look at these signals and say, look, if there's going to be opportunity outside the US, where would it be? We've missed the European one, but we've definitely hang on to the Chinese one, and we do think there's potentially more scope. I mean, those valuations are still not close to where the US ones are. They shouldn't get to the same level. There should be a premium between the US and China, but there's still some legroom there.
Thanks, Chris. Riyadh, maybe just quickly on global, we need to speed it up a little bit. If we look at global the last decade, well, actually last 13 years, growth and quality actually dominated the landscape. From a multi-manager perspective, do you think that is this a tipping point that people need to include more value-orientated managers? How do you look at it?
Yeah, I would agree with Jacobus, and we would say that we think that given the high levels of interest rates and the fact that it really looks like it's not coming down, definitely not to zero, that's changed the landscape. And so, we would argue we've almost entered into an environment whereby value is back. You can see it even in the last 6 months. The US, year to date, the US is down, the other regions are up, the dollar is weak. And so, I think being underexposed to that area of the market, and in terms of sectors, financials, energy, materials, they would definitely fall into that value camp. And so we think that people have almost forgotten about those. And we would encourage people, and we've certainly tilted our portfolios to have more exposure, to those sectors. Not to say that growth is non-existent. There's companies under the hood, that will fall within that growth category. But just in terms of the Mag 7, we think it's an opportune time to underweight those and have exposure to a more diversified portfolio.
Thank you for that last one on global, and it will partly speak to one of the comments from the audience. Mark, if I look at your global carve-out, you actually outperformed the MSCI, where everybody says, no, you can't, active managers can't outperform the MSCI, and you've done it for a couple of years now, continuously. And I mean, it does make the point why, some active managers actually do their job and they can actually outperform. And that's maybe why you pay a little bit more fees relative to non-active funds or tracker type funds. And I do believe we are in an environment where you need stock pickers, we need active management. You can't just buy stuff anymore blindly. But maybe just quickly on your global, I mean, how do you do that? I mean, because in the past 10 years, if you're underweight the Mag 7, I'm not talking about the past 2 months, but then you just lost out, but yet you still outperformed with hardly any.
Yeah, thanks, Eugene. I mean, it's actually our global equities has been the strongest portion of our business. I mean, so how we approach it is that, we screen the All Country World Index. That's the starting point, and a lot of those metrics are quality metrics. That gets us into a short list, roughly 250 stocks, which we then distill down to the current coverage that we have, which is just over 100 stocks. That we put under model. We look at each company, so everything's from a bottom up as opposed to looking for trends or themes. And from there, I mean, we're looking at companies that obviously got competitive advantage, well managed, have sustainable businesses practices, and operate in good industries. And then, I mean, I think with the luxury of playing in the global space, you actually got, it's to some degree, it's a lot easier than playing in the local market. You know, you've got thousands and thousands of stocks to look at. And, you know, we follow a very disciplined approach. Not to say that others don't, but I mean, basically, it's very rigorous. We're very sensitive to the price that we pay for things. And if you think about it, over time, the things that impact your opportunities is large movements in price away from value. And if you can be sensitive to that, you can very efficiently make sure that you're exposed to the right companies. Yeah, I mean, that, you know, that's the core of what we do. So, I mean, you know, all our effort goes into making sure that, you know, our buy lists are as accurate as possible. And we are very efficient at trying to execute in terms of what the prevailing price is. And obviously, if there's volatility in the market, that actually gives us lots of opportunity to take advantage of. So, yeah.
Mark, thanks for that. One question from the audience. I'm going to throw it to all the panelists out there. In multi-asset funds, obviously a component of that is bonds. We know that bond yields did exceptionally well. Riaan, you mentioned that as well for 2024. Some bond funds gave you very close to 20%. Going forward, views on SA bonds. Do you want more or less in the portfolio? Especially now that I listen to the opportunity sets in some of the other global regions like the EU, UK, Asia. If I look at SA equity, do I now cut on my bond exposure or do I hold it? What do I do?
Well, I would go first. I would say that you need to be able to be tactical around your allocation, because at certain areas, when yields approach, if we take the 10-year, for example, when it approaches 10%, we think that there's a lot of good news priced in. But above 11, you know, it starts offering a lot more value. So we think that you do want to be exposed, but you want to be tactical. And you want to monitor, you know, volatility around it and take advantage of key events coming up, whether it be the budget next week, whether it's going to pass. You know, we think that there's a lot of volatility on offer in the SA bond market, and that will give you opportunity to enter into longer positions at more attractive yields. So definitely we want to have exposure, but you want to be quite tactical around those.
So the way I think about it from almost like a returns perspective is that if you look at the 2035s, which let's use it as the bellwether for the index, they're yielding 10.7 today, right? And they pay a coupon of around about 9%. So every year you get 9% in coupon. It rolls down the curve to a 2032 at about 25 basis points a year, which means another 1.5%. Per year. So your starting point at the beginning of the year is almost 10.5% of return. Then you have to factor in the capital impact. And so for you to get into a negative return on SA bonds from these levels needs to go to above 12%. The 10-year needs to go potentially to 12, 20, 12, 30 before you actually get into negative territory. So it does provide you to some protection, right? Now on the opportunistic side, we think fair value, like Riaan said, is potentially around 10.25. You think about US at 4.24, inflation differential 1.5%, 3%, credit risk premium another 1.5%, country risk premium. We get to around 10.25, which means there's 50 basis points of compression that can potentially take place, which will take your bond return this year from these levels potentially in close to the 15%, 12 to 15%. So we do think there's an opportunity. There's also some risks, and therefore you have to be tactical, as Riaan said. So we are at the moment very neutral-ish, slightly overweight, looking to enter again into these bonds. But I think they are attractive relative to many other asset classes.
Sinclair, if you maybe want to add to that, because we know that the SASFIN and some of your mandates, you have a more absolute return mindset. And if I look at your multi-asset high equity and the medium equity funds, some time ago you had a lot more fixed income exposure, because I mean if you get inflation plus 4 or 5, why not just stick to fixed income? SASFIN positioning at the moment in 1 minute.
In 1 minute. So right now we are neutral, we're sitting in the neutral camp. But I mean, to build a case for bonds right now, I mean, they play a huge part of our portfolio. If you just look at the real yield, I mean, inflation has come down quite a bit, right? You're getting a real yield of on the 10-year of about 7.3 or 4. And if you look at the last time that you got that yield was at the height of COVID, right? So it's quite a good yield. But I mean, it's not to say lock in the yield and to not be tactical about it, right? You still expose yourself to interest rate risk or inflation risk. And so as Rian and Jacobus mentioned, you got to be tactical at certain points as well as you hold on to these bonds. But right now the yield you're getting is quite attractive. But we do think that you're sort of at the fair levels for SA bonds.
Right, Mark, I know you want to add to that, but we're going to go on to playing 30 seconds very, very quickly. So I'm going to throw statements out there that we get from IFAs and investors, and any one of you are welcome to comment on that, but you really only have 30 seconds. Anyone that answers gets 1,500 supportive points. If anybody adds to that, you get 1,000 supportive points. We'll see who wins at the end of the 32nd round. Right. A return objective of CPI plus 6 is still achievable for a multi-asset high equity fund. Yes or no?
Yes.
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 Why yes? Because we haven't seen that. Last year, yes, but before that, not.
So we think we can get, inflation is definitely on the lower end of the band. So inflation plus 6, even if it gets down to or gets up to 4%, bonds will give you, we think, early double digits. Equities have the potential to do mid double digits, plus some offshore exposure. So we think that that's definitely achievable over the foreseeable future.
I'll use
Thank you
Ryan's.
for that. You'll get a third. Yeah.
Sorry, Eugene. Ryan's got 5 seconds left. I'll use that. The select BCI returned 14% over the last year, since inception, the last few years. I think that is CPI plus 6.
Exactly that. That answers one of the questions from our audience as well. Tariff wars are inflationary, but we haven't seen any of the tariffs landed yet. Supply chains will be disrupted and further dampening global growth. Are we still going to see a US recession?
Yes.
Yes.
Oh my.
Yes, our view is that we will see much slower growth in the US because of the consumption, and the consumer is under pressure. You look at delinquency rates; they are close to back to GFC levels. They're creeping there. Savings rate is rising because people are unable to or not willing to spend anymore, and so therefore we're seeing a slowdown in that consumption. That could push us to, let's call it a shallow recession, not a deep one, but potentially a shallow recession.
Yeah, we think that there might be an argument that the US is already in recession, and although tariffs are inflationary in the shorter term, ultimately it's a tax on the end consumer, and so it actually happens to be deflationary over the long term.
Right, on the next one. Because of tariff wars, despite what Trump wants or doesn't want, the US dollar is going to remain stronger for longer.
No.
Not.
I'd say
Maybe.
The dollar's had a good run.
Mixed.
Yeah, it's unlikely.
Right, next one. The June news too fragile. It has got no growth, high debt to GDP levels, so Rand is doomed.
No.
Look, I don't think doomed. But if you look at history, right, let's take US dollar to the US Rand to the US dollar. I think on average, depending on where your starting point is, you've had a 5% depreciation. So I think over the long term, you will have that continuing. But I don't think the Rand is doomed. I think there's some positivity. I think you've got to give a lot of credit to just what's happening around our coalition government. If you look at what happened last year in June when it was formed, that risk unwind, investing in SA sort of, so that risk was unwound. So you sort of had a strengthening of the Rand somewhat. So yeah, I think there are still a few things that could sort of counter that depreciation.
He's got an extra 2,000 points for that answer. Right.
I think the fact that we got commodities might be one of the savings graces. So yeah, the fact that we got commodities will be a big factor as to the future of the Rand.
Let's see. Next point. China is uninvestable.
No.
That's the exact point why you should invest. When those are the headlines, that typically is the bottom of the market. So I would definitely disagree with that.
Also
Rian,
disagree.
Rian, take it a bit further. I mean, how do you get exposure to China? Do you buy direct exposure in China, A8 shares, or companies that benefit from China? How do you do it?
I think you can do it in various ways. We obviously partner with offshore managers that will either buy the shares listed in Hong Kong directly in China or even the ADRs. So, we've certainly not put any restrictions on them. As I know, many other players have actually said to guys, you need to give us a portfolio ex-China. We certainly disagree with that statement.
I'm going to move on to the next one. I know you all want to comment, but let's move on to the next one. Global bonds are a great hedge at times of uncertainty and maybe even better than gold.
Yes.
Yeah.
If you look at the bonds, where they're trading at the moment at 4.25%, and you look at where the policy rate is at 4.5%, if you are going to go into recession, then you need to drop the policy rate to below the neutral rate. Now, it's very hard to know exactly where the neutral rate sits, but the Fed thinks it's 3%. And so if you have to drop rates by 125, 150 basis points, you will see bond yields in the US come down as well, and that will benefit you from a return perspective. And so that's why we own them in our portfolio.
Yeah, and we think it's a great hedge for SA specific risk. And we've just gone through one of the biggest bond bear markets, I think, in the history of bond markets. So with rates having reset, you're starting to get a margin of safety again, like your previous and with the SA yields, and it's in all likelihood yields are coming down, not up. So we think it's a great hedge in your portfolio.
Yeah, we also have a decent slug of global bonds in our balance fund, and that has predominantly been US Treasuries. So yeah, I concur. We're at a point now where you're getting decent yields. Going into COVID or through the COVID experience, when yields got down to below 1%, that was certainly not a good time to be getting exposure. But for the first time in more than a decade, you actually, in that global fixed income space, you stand a chance of delivering a real return. So yeah, definitely not an asset class to ignore.
Thank you for that.
So also concur with everyone. But I think, again, if you look at history, looking at where US Treasuries are trading at, I mean, it's a similar point to the GFC. Are we in the same similar risk environment then versus now? I don't think so. So quite a good deal that you're getting currently.
Very interesting indeed. Very last one. Everybody expects more volatility for 2025. It's a main theme. It's what we hear continuously. But can volatility be your friend?
Yes, absolutely. I think you must never shy away from volatility. It often gives you great opportunities to enter into asset classes or shares or bonds that will give you great prospective future returns. So always by having cash on the sideline is a great strategy, I think. And so volatility is your friend, definitely not your enemy.
Anybody want to add? Last comments.
Yeah, I'll just add maybe on the volatility front. I mean, we've seen a lot of uncertainty. We've seen a lot of big headlines, but we actually haven't seen massive spikes in volatility recently. We've had some increases. So the way I think about it is play the macro, not the man. Don't exaggerate the headlines and make things worse than it actually is. Look at the actual data, look at the actual underlying, and see if there's a real opportunity. That's what I'll say.
Well, so I'm going to finish on that because I think that is a very powerful message to investors out there. We lend our ears out. And I mean, if we look at markets, what's happening at the moment, people are getting less sensitive to the Trump rhetoric. And trade wars, none of us tariffs actually landed yet. So we'll still wait and see. There's great opportunities out there. And I mean, to the audience, like I said, we've seen an uptick in interest in multi-asset funds. We know exactly why. It's very hard to pull all those levers from an asset allocation point of view, and more so from a regional point of view or sector or security point of view. So it does make sense to combine a couple of good multi-asset funds. All the gentlemen on the show this morning showed great skill over the past decade in tactical asset allocation and on stock selection level as well, or fund manager selection, Rian, from your team side as well. Gentlemen, thank you so much for joining us this morning. It's unfortunately all we have time for. We covered a lot of ground. I stole some time as well, but it was really, really a lot of fun. We can try to do this in the near future as well. Thank you so much for joining us.
Thank you.
Thanks, Eugene.
Thanks,
Thank you, everyone.
Thanks, Eugene.
Yeah.
Bye.
Yes, sir. To our audience out there, very quick reminder, next week, Wednesday, we've got time, wealth, and video fund management. We'll continue our conversations on what to look for in this environment. Thank you so much for for joining and for your continued contribution. Chat to you soon.